The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by the Monetary Authority of Singapore, MAS, and Ministry of Manpower, MOM. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding exchange-traded funds, ETFs. This is the first video of a two-part series on exchange-traded funds, or ETFs for short. In this video, we will provide a basic understanding of what ETFs are and the types of ETFs that are available to investors. What are ETFs? Before we talk about ETFs, it is best to first understand what market indices are, as many ETFs track indices. What is a market index? A market index is a representative sample of assets from a particular market or sector and is expressed as a single value to reflect the relative value of the whole market as well as to track the market's movements. It is possible to construct indices to represent and track markets such as those for stocks, bonds, and commodities. The properties of a good index are: it should be widely accepted and recognized as being appropriate for the market it represents. It should also be transparent, for example, its constituents, selection criteria, and construction method are known. Lastly, it should be easily measurable. The Straits Times Index. The most widely recognized index for the Singapore stock market is the Straits Times Index, or STI. The STI comprises a basket of 30 stocks that are selected on the basis of size and liquidity. For example, DBS, UOB, OCBC, Singtel, and Keppel are all components of the STI. The total market capitalization of the STI is about 2/3 of the entire market's capitalization, so the 30 stocks are taken to represent the whole market. Each stock is weighted by its market value, so stocks with bigger market value will have a greater influence on the index's movements. The STI is used as a benchmark for the Singapore stock market. Here is a chart of the STI from 1997 to 2022. This chart shows how stock markets might behave over a long period of time. You can see that the market can rise or fall sharply, which means it can undergo a lot of volatility. Stock markets are affected by changes in the macroeconomic environment, like in 2008 during the global financial crisis and the COVID-19 pandemic in 2020. However, the long-term trend is generally upward. Observations about stock markets. As mentioned earlier, markets can undergo bouts of short-term volatility. As such, trying to time entry into and exit from the market while picking the right stocks can be difficult for most investors. However, since the long-term trend is upwards, passive investors or those who don't want to actively have to pick stocks and try to time the market might prefer to just buy and hold the index. This is how the ETF industry started, catering to the wishes of passive investors. What are exchange-traded funds, ETFs? Exchange-traded funds, or ETFs, are similar to unit trusts because they are funds that can be either open or closed-ended. However, they differ from unit trusts because they are listed and traded on a stock exchange. Most ETFs are passively managed and are also known as tracker funds because they aim to produce a return that replicates the performance of a specific index. In other words, an ETF tracks the performance of an index. The fees charged by ETFs are usually lower than unit trusts because ETFs are passively managed, which means that the ETF manager does not have to actively select stocks to beat any benchmark. ETFs can be either cash-based or synthetic. These structures will be discussed in detail in the next video. Whatever the type, investors in the ETF participate in the performance of that index's constituents, so someone who buys an STI ETF gains exposure to the movements of the 30 stocks in the STI. Types of ETFs. There are many types of ETFs available to investors. They can be broad-based, in which case the ETFs will track major indices that represent entire markets. Some examples would be the STI, which represents the Singapore stock market, and the Dow Jones Industrial Average, and the S&P 500, which represent the US stock market. Sector and industry-based, in which case the ETFs will track indices that represent sectors like banks, real estate, or REITs, energy, or oil. Global-based, in which case the ETFs will track entire geographical regions, such as emerging markets. Fixed income-based, in which case the ETFs will track bond indices. Specialty-based, in which case the ETFs will track indices that represent themes, such as high dividend-paying stocks. Risk-return trade-off. Before we look at how ETFs are structured, here is where ETFs stand in the risk-return continuum. ETFs rank just below shares and derivatives in terms of risk. Here are the key takeaways. Stock markets can undergo bouts of short-term volatility, but the long-term trend is usually upwards. Exchange-traded funds, or ETFs, track indices that represent different markets or segments of markets. ETFs are suitable for passive investors, for example, those who just want to buy and hold to gain exposure to a particular market or segment.